The real estate market is always evolving, shaped by economic shifts, lifestyle changes, and global trends. Today, we'll explore how Malaysia's property sector performed in 2025 and what the future could hold as we step into 2026. Joining us virtually is Sulaiman Saheh, Director Research and Consultation Services, Rahim & Co. International. Sedang Berhad, I want to say thank you very much, Sulaiman, for joining me. Firstly, we're going to take a look at the market performance and resilience. 2024 saw record high transactions, but 2025 began with cautious sentiment and affordability concerns. How would you characterize the overall performance of Malaysia's property market in 2025? Did it meet expectation or fall short? Which subsectors, residential, commercial industries, perform best and why? Please share with us.
Thank you. Happy to be here again. About the property market in 2025 to date, the market has actually showed some signs of moderation, or I would say normalization, from a robust performance that was seen in 2024. If we remember how the market was since the turn after post-COVID, the market actually rebounded very well in 2022. Then it was actually held again in 2023, but 2024 it showed further acceleration. This acceleration is actually overperform basically, and from there we actually expected some moderation within the market. Be it the market demand, especially for the affordable segment, is still very strong. The demand for good properties, investment properties, is still there. But the number of transactions, because of the high figures in 2024, it did show some signs of moderation in 2025 to date. It was actually a larger decline in the first quarter. It actually normalized a bit in the second quarter, and coming to third quarter now, we are actually recording a slight reduction of 2.1% in the total volume of transactions. Be it that the total value of transactions actually continued to grow. It grew above 5% for the same period for the first 9 months of this year compared to last year.
And despite steady growth, affordability remains a pressing issue with rising SST, construction costs, and financing hurdles. How close are we to a tipping point where affordability could significantly dampen demand? What structural reforms or policy intervention do you think are most urgent to address this?
Affordability is a major concern, not just in Malaysia, but across the world, all over. But for the Malaysian perspective, affordability remains a big issue with the lagging wage growth in terms of the growth of our annual income or annual salary compared to the growth of property prices. We do understand property prices, especially for the primary market from the developers. They are also being challenged with the rising cost of construction, labor supply, as well as the other different factors. And within now, since the middle of this year, SST actually is basically roped in. The SST actually being deployed for construction services, except for the residential segment proper, but because we can see a lot of developments in Malaysia right now are actually service apartments on commercial properties, where the integrated commercial nature would also attract those kind of incremental costs of construction. And this actually cascades down to the overall cost, which then affect the selling prices, especially for the developers. Looking at that, with the cost being a primary concern that fueled up the prices that's still high, there is a bit of moderation in terms of price growth. It actually slowed down a bit in the third quarter, which actually gives a telltale sign as to affordability still remains a main paradigm where the project can be marketable and sellable within the market. the number of overhang units, although it has actually stabilized somewhat. The residential segment actually showed a bit of increment, but the service apartment segment actually showed a bit of a decline because the market has actually absorbed. That's probably due to the slower new launches that's been launched in the past a few years because of the challenging market that gave the market time to actually absorb some of these unsold units. Moving forward, I think with regards to the affordability factor, I think government intervention and government incentives, as well as tax breaks to the developers, as well as some assistance, financial assistance, the stamp duty exemption for the prices of properties or houses that are below 500,000 should still be continued, especially to help the B40 and M40 in attaining their first home buyers market. And these are supposed to be continued on. Just to show, just to also share, with regards to the affordability factor, we also need to actually appreciate the total cost of occupation, if you like, where some of the developments that are within TODs, the transit-oriented developments close to LRT stations or MRT stations, more focus is supposed to be put a bit more emphasis on these affordable segments or the mid-market segments, because these are the most in demand for those people who are actually not so reliant on public transportation, or so reliant on private transportation and relies more on public transportation, which are commensurately more akin towards the M40 market or the B40 market.
Sulaiman, we have a few minutes. From developer and investors' view, how will BTS and the Urban Renewal Act affect supply, cost, urban property dynamics over the next 3 to 5 years?
The BTS, or Build Then Sell program, is actually one of the highly debated issues right now, and it has actually been around in market for the past 15 years, if I'm not mistaken. The issue here is due to the affordability is one, and another thing is actually the abandoned projects issues that we actually have. The abandoned projects or sick projects or delayed projects. These risks are really, most of it is, the risk is burdened to the owners, to the buyers, who actually finance the project as they pay as progressive payment, which is the sell then build. But it is that same system that we have actually deployed for all these years, which allows developer to defray some of their capital outlay, the upfront capital outlay for the development, which is actually subsidized or basically financed from the progressive billing or the progressive payment that they receive. This would actually impede in terms of some financial challenges especially for the smaller developers. Cash flow management is going to be very important, and hence the larger companies can actually have better strength in addressing this or strategize towards the BTS program. But the Sell Then Build program should still be looked at because the transition is going to be more, it's expected to be more moderate and more gradual rather than total transition in one go. And it is also selective according to the market. The URA, Urban Renewal Act, is actually one of the highly anticipated acts also. It is actually a way for us to actually look at how to rejuvenate or revitalize certain segments or certain dilapidated or underutilized properties that we actually have. But also, this is where it is easier said than done, because if it's a development, a redevelopment for a property that is only single owner, it's easier to manage. But when it comes to multiple owners, we need to address to give an equitable compensation or mechanism so that it's going to be a win-win partnership.
All right, Sulaiman, probably we're going to take a look at the as recovery is only expected by 2026. Maybe you can share with us what are some of the biggest risks or uncertainties that could derail this trajectory? Is it global economic shocks, domestic policy changes, or structural issues like overhang and aging stock? We have a balance of less than 1 minute. Can we help to wrap it up?
All right. The global economic challenges still remain, and that becomes a backdrop for everyone. That's basically how our foreign policies and our government is actually supposed to address that from a fiscal position. Because Malaysia is dominated by the local market predominantly, so it is going to be within the local market that is actually going to see more changes or more vulnerable to any changes. One of the risks I would actually say is the consistency of policies and how it is being deployed, or basically how it's being rolled out to the market, so that the market confidence and sentiment is actually being taken care of in order for the whole market, be it private sector, public sector, can move forward together.
All right.